Hi there, I'm Malcolm Graham Wood and I'm doing my Core Finance CEO interview. Except today I'm speaking to Andrew Austin, who is chairman of Kistos, the new entry to the London market. Hi Andrew, welcome back and in a new guise.
Hi Malcolm, always a pleasure to see you.
And you. Well, congratulations. You got you completed and got away the Kistos IPO pretty successfully. You raised £31.75 million. Pretty impressive raise in current markets, I would suggest. And the shares have gone up some 20% since first day of dealings. Talk us through how it's all gone.
Thank you. Well, we've raised actually in total 36 million pre-expenses because we had a previous raise of 4.25 million, and then 31.75. And everybody who was in that first raise was required to put in twice as much money to the second round. Then we had an institutional round. So we raised just over £20 million from institutions. A number of those were institutions who had previously been involved with Rockrose. And I'm not sure whether you're aware, Malky, but the origin of the word Kistos it is actually Greek for Rockrose. So there is a little bit of a theme running through this. So let's hope we're any part as successful as we were last time out.
Well, that would be great. Tell me, how did you go about sorting the valuation and the dilution and so on when you decided on the price?
Well, we talked to a number of institutions as well, and we, even before we raised the first round, we said this is what we want to achieve. The main objective of structuring it the way in which we did was we did not want a load of options and warrants and anti-dilutive instruments in there, as a lot of small AIM companies have when they come to the market, as I'm sure you're aware. And someone suddenly gets some nominee shares that are able to, it suddenly accelerate. We said everyone's money counts basically the same. So there are no other warrants, there are no other options. Everyone's subscribed for their shares, and that's it. So what we did do was we gave a pre-money valuation to those that came in the first round, but in doing so, as I said, they had to commit to money in the second round. So you put money in at 50p, but in return for that, you have to put in. So in my case, for instance, I put 3 million in initially, and I put a further 6 million in the main raise. In the end, I made that up to 7.5, but we can come on to why that was the case later.
We'll talk about that we'll talk about that in a minute.
The institutions felt that the 4.25 million pre-money valuation, which we were effectively giving by doing that, was actually quite a low number, given the track record we'd done, and also given that there were no other dilutive instruments out there.
Excellent. Well, that answers a number of points. The obvious question, I've been talking to a lot of the retail and some of the institutions in the last few days, is this just unfinished business from Rockrose? What are the similarities you see? We'll come back in a minute to what you're going to invest in, but what are the similarities, would you say?
Well, the similarities is this is going to be very much deal driven. We as a team, as a management team, the people that are in common between the two organizations have built Rockrose on doing deals, and Kistos is going to be done that way as well. We're not looking to create anything here with the drill bit. We're here to buy assets at reasonable prices, maximize the value if necessary, if it makes sense, repurposing those assets and then building a portfolio that has a meaningful valuation, and the sum of the parts is greater than the cost of the parts, if you see what I mean. Which is obviously what we did previously. So that's the similarity. We're not going after black oil this time. I think there is money to be made in black oil, mind you, but I just don't think it's easy for that to be done in the public markets. I think with the ESG agendas that are out there, especially with institutional investors, to attract institutional capital to a black oil business is seriously difficult. So it's Kistos, it's energy in transition. We're looking at gas, we're looking at gas storage, we're looking at the infrastructure that makes energy transition happen. standby electricity generation, what's needed to enable the world of electric vehicles, etc. All of these things, but not because we're going to go off and look at new technologies, but rather we're going to look at old assets that can be repurposed for that agenda.
Yeah, it's certainly different. I mean, not black oil, and you've got opportunities. I'm glad you said at the end that you were looking at sort of some specific assets, because sometimes storage and infrastructure, and I mean even the phrase energy transition makes people think sort of you're looking further down the track. So what should people be looking for then? I mean, I'm not asking for now. I'll come back and ask you who you're going to do in a minute. But
Well, I went
energy transition. How does...
Look, we're only looking at things that we can make money out of and make money out of in short term, right? So, we're looking at a number of income producing assets right now. We're looking at some things that we can buy that we can repurpose into other applications. So those are the kind of things we're looking at. But we're here to make money. We're not here for the dream of a greener future. I might have grown a beard, but I'm not wearing sandals at this point.
I can't see that happening either. So let's look at the timetable. You must have looked at one or two things already. So what might be around, and then what size are you talking about? I mean, you must have first of all, you must have a sort of size limitation.
Well, we've got, as I said, we've got 36 million pre-expenses of cash. So that takes us to about, I don't know, 34 and a half million net of cash. With our drain on capital is very, very low. You'll have seen in the admission document that we've set this up on a post-COVID environment where people are working from home with good IT solutions. There are all the board is just being paid a flat board fee. There is no big salaries involved. My executive assistant's the most highly paid person in the company right now. So actually, she's the only person employed in the company right now, to be fair. But the running costs are incredibly low, Malcy. We've got a lot of money to basically put against the road. It probably gives us an appetite of up to about 100 million of acquisitions when you look at the debt equity split without diluting where we stand. Which we can do at the right price.
Yeah, and you've got, you mentioned dilution, but there were one or two quite big shareholders in Rock Rose who I seem to remember you saying weren't able to immediately come into Kistos because it was deemed to be a shell or didn't have any assets and so on. You presumably give them a ring when you're doing a deal and get a bit more firepower from there.
Well, exactly. And I mean, there's a number of people who are actually quite disappointed under their investment criteria that they couldn't be involved in the transaction until we've done a deal. So once we've done a deal, that will provide, again, some institutional support, which hopefully will help take us forward. And, that's the same model as happened with Rock Rose again as well. It was much easier for us to get institutional investors in place the bigger we got. And I anticipate that being the same again. So there's a number of people who've made significant amounts of money who physically can't invest at this point, but obviously are following the story closely. Yeah.
And timetable wise, I mean, we've joked about getting something done straight away because you haven't been idle in your retirement since Rock Rose. So I presume the market might expect something at the beginning of next year.
I think that's very reasonable. Obviously, I haven't been idle. I think from the time the money was paid to shareholders for Rock Rose to first day of dealings for Kistos was about 2 months, I think, which is probably a record in that.
Yeah.
I
don't think sort something out for me.
I don't think even Martin Sorrell did it that quickly, did he?
No, probably not. You mentioned earlier on that you had to put in a bit more than you initially said, and in the documentation it means that you've come out as being a over 29.9% shareholder. Can you just give us a sort of the facts and figures about that? And
yeah, sure. What happened was we were oversubscribed. We were quite significantly oversubscribed, and then literally after we'd closed the book, one of the cornerstone investors materially cut the size of their order. So we then used some of the oversubscription to cover a proportion of that. And then rather than go around investors again and try and find some more money, I put in another $1.5 million of my own money at that point. So that's why it was the case. It doesn't, there was already effectively a concert party for the people who put money into the first round. So there was already a whitewash in place. So it wasn't a problem for the 29.9% having to make an offer for the company. So we've done that. Obviously, that's not where I intended being, but I obviously won't be selling that stock. So if we do end up diluting with equity at some point, then I would quite like to be back down at 29.9, but it won't be done through selling stock. It would only be done through dilution.
Yeah.
If we end up not diluting the company, which is highly likely that we don't dilute, then I'll just stay at 34% as I am.
And the panel will just let you do that, and they won't. There's...
Well, because there was a whitewash in place because of the concert party in the prospectus anyway. It's all detailed in the prospectus.
Yeah, I saw all, and of course the familiar names from Rockrose were there as well. But
yeah,
two quick questions that to a certain extent you've half answered. Your new board looks very experienced, and at the moment all non-executive. So first of all, a quick word on the new board. And everyone is saying that lots of people are going to walk over from Rockrose and join you. I presume that's got to be true, but talk us through the board and the team.
Yeah, sure. Well, the board, Richard Benmore was obviously on the board of Rockrose previously. Julie Barlow worked with us at Rockrose, but also worked previously with me at iGas. Julie is someone who is, firstly, is a management accountant, but also is very skilled in integration of businesses, and worked with us a lot over the years in integrating businesses. And she remembers all the things that are easy to forget in terms of when you're bringing a new business into the fold that need to be considered. So that's a really, really strong skill set. And it's a team that's been very well proven working together before.
Yeah.
Alan Booth, I'm sure, is known to many in your sector. I mean, you know Alan well, Encore Oil, and then obviously sold out for a very significant amount of money to Premier back in the day, and then ended up on the board of AFIA, and then after Nick Cooper left, stood in as interim CEO and saw that through an exit, which, for those that remember at the time, was quite hard work to do, and quite hard work to, this was a business that had effectively repositioned itself completely faced towards Asia as the value of the African assets was deteriorating, and Alan affected an exit.
Yeah.
And I think if you'd been sitting around as a shareholder still of AFIA in the first half of 2020, it would have been a pretty uncomfortable ride. So I think Alan did a good job by shareholders. I know at the time some people sort of said, "Oh, could he have extracted a greater premium?" But he extracted an exit, and I think that was very valuable.
Yeah,
and particularly with hindsight.
And the team in the sort of middle management and
well, I mean, the team that's in Rockrose is still in Rockrose and working at Rockrose right now. Who knows what will happen in the future? You pointed out that a couple of people are obviously investors in Kistos as well. We'll see what we buy as well, and we'll see what that means in terms of staffing we need. Sometimes when you buy things, staff come along with it as well. But obviously, we're a close-knit group of people, and when the pubs reopen, I'm sure we'll be sharing a bottle of wine somewhere.
Yeah, I hope so.
With a Scotch egg, apparently. You need to have a Scotch egg.
With a Scotch egg.
It has to be a substantive meal.
That's easy enough. Right, we're getting low on time. It's been a different interview in the sense that, we're not talking about anything specific. We're talking about your ideas and your plans. So the last question will be about your plans, even though you've gone through them in some detail. You're talking about, as I say, a company 35-40 million at the moment. And you've talked about where you want to go and when you want to go. How would you see Kistos in sort of 12 to 18 months, which is the sort of normal timetable? How long would you see getting underway?
I think, as you said earlier on, as you asked the question, I would hope to be announcing a deal early in the new year. We've got a couple of things on our radar. Obviously, we weren't able until the company's floated to deal with anything other than in the public domain information. That's a requirement when you're listing a cash shell. But we're obviously gone full steam ahead with a number of potential acquisitions, and we should be able to deliver on that quite quickly. I would expect to see us producing revenue, producing a sensible EBITDA, and with a couple of acquisitions under our belt by the end, closed by the Q4 of next year. And
you paid it in the old business. Actually, to start with, it was a little uncertain because you did a buyback, you did distributions of special dividends, and then got onto the dividend. Have you got that sorted out beforehand this time, or are you going to sort of play it as it goes?
I think so. I mean, well, look, remember why we did it, okay? We're very, very conscious that it's shareholders' money, not the company's money, yeah? And we run this business on behalf of shareholders. And obviously, I am a very significant shareholder myself. But therefore, if we can't apply the money at the time, then we'll return it to shareholders because it's their money, yeah? We raised the £1.50 on when Rock rose, or the money at £1.50, because we anticipated doing a transaction which we then didn't close. We did something else instead, and so we felt an obligation to pay that money back, which is what we did. But there is a progressive dividend policy here. Yeah, there is a commitment to try and make dividend-based returns for shareholders. If we feel the share price is at the wrong level, and it's appropriate we've got the right retained earnings to buy back shares, we'll go and buy back shares. Yeah. We will carry out the right moves to advance the capital structure on behalf of shareholders. Too many companies across our sector, across the space generally, are run for executive management salaries rather than for shareholder returns. Trust me, this one's run for the shareholders, and I can say that both in my role as chairman and as the largest shareholder.
Excellent. Andrew, thank you very much for talking to me this afternoon. It's been very, very kind of you to make time.
Thank you very much indeed, Malcy. Always a pleasure.
And we look forward to seeing you again. This has been our CEO interview on Core Finance. My guest today has been Andrew Austin, who is the chairman of Kistos PLC. I look forward to seeing you again soon. Thank you very much. Bye-bye now.